Welcome back to Dear Rochester, Retire Well. Here's your host, Dave Pulcini, CFP.
Welcome back, folks. How you doing, John?
I'm fantastic, Dave. How are you?
I'm great. Folks, we're back with the third one with John. I feel like this has been every week, John. It's a lot of John Harms in the last 2 months.
I definitely wouldn't feel it every week. Otherwise, I don't know if I could get out of bed. It's a lot for me. You know that.
It's a lot for a chief investment officer to talk about the markets, right? So that's what we're going to get into. Q3. John, what's Q3? Q3 seems late to me, like Christmas time. What are the actual Q3 months?
Quarter three, starting July, you go to the end of September. It's basically the quarter of the year.
There you go.
3 months.
July, August, September. So we're going to talk about the markets and what happened during that time. And then John is going to do what he always does and guarantee us a rate of return by the end of the year in the S&P 500. So, John, take it away, man. What happened in Q3?
Yeah, you're actually skipping ahead to next quarter's update where I talk about that stuff. But I first want to commend you. Obviously, I appreciate being on the podcast all the time. But it's just a testament to Dave's leadership abilities that he can get a guy that just likes to sit in front of computer screens to come out here, talk in front of a camera. I can look at it right now and have a big microphone right in front of my face. So
bribery.
It's a lot. I also want to kind of let the listener, the audience know some of how the sausage is made. Maybe I'm not supposed to say this, but you guys have no idea how many people Dave has, makeup, hair, all this before we do this. It's incredible. I think nobody for me. There's not one person for me. Like 18 people running in and out helping Dave look good, which he doesn't need much. I
have to look better
help.
than my guess.
I think he wants me to look like Nixon sitting across from Kennedy at the debates, sweating and all that. Anyway, so let's get into it. I enjoy these. This is actually my favorite one to do. You can kind of review what happened, what we thought was going to happen, what we can kind of look forward to. So first and foremost, the economy, give you a little overview. Economic growth, consumer spending, these are some of the top things I look at. Economic growth, you're kind of looking in arrears with economic growth. So the information we got in the third quarter was really more about what happened in the second quarter, but we saw fantastic growth. We saw 3% GDP growth. You start to get a little bit of information that gives you a hint on what third quarter is actually looking like. And the Atlanta Fed comes out with some numbers, and it was pretty recent. They upward revised their GDP estimate from 2.5% to 2.9%. So we're in the midst of what I thought last time, and I kind of mentioned it then. We hear a lot of talk about, the R word, recession, when's that coming? And again, I just don't see that, if I'm looking ahead. We're seeing some good growth. Consumer spending is increasing right now by a good rate. Retail sales are showing an annual growth rate. So the consumer is actually looking pretty strong. From an employment standpoint, that's another thing I want to look at. I would call the job market resilient. It's been coming down from very high numbers that, we had these post-COVID high employment numbers. And we're still actually above pre-COVID levels when it comes to total jobs numbers. It's just in a declining trajectory because the high numbers we had. So we actually have very low layoff numbers right now. Labor participation numbers actually are at some of their highest levels we've seen, which is fantastic. And then wage growth, there's pluses and minuses with that. But I'd say overall, it's we're seeing growing wages, at least, keeping up or trying to keep up with inflation. Right. Corporate earnings. So again, this is one of those things we're kind of looking at what happened in quarter two. In quarter three, they're reporting on what happened in quarter two, and we get some sort of projected estimates of what the upcoming revenues are going to be. But we saw increased profits in quarter two. We saw earnings growth expected to continue into this quarter and next, and actually throughout 2025, still getting earnings projections that are higher. Big one, Federal Reserve. So we talked about it last time. There was a lot of talk about when they'd start cutting rates. So in September, they actually did their first rate cut. It was 0.5%. Some people expected 0.25%, some half. So we saw the half. And as of right now, the numbers change, but there's likely projections of another 0.5% by the end of the year. So What I just saw a couple days ago is, the futures markets and all the traders that bet on these types of things. There's about a 90% probability based on those numbers that we'll get a 0.25% rate cut a couple days after the election. So the Fed has been kind of forecasting, and their language has been more preparing the markets for lower rates, and how fast we'll get there is obviously something no one can really accurately predict. But I think what we're seeing a lot in the markets, and I'll talk about this, is the market anticipating those rates coming lower based on what the Fed is telling us right now.
So John, if people are betting on the markets or the rate getting cut, and then it doesn't get cut, are you going to talk about that? Do I always ask you questions that you're going to cover later?
I mean, we can talk about that now. It's a fantastic question, and actually I think about that a lot, the market right now, I believe, is pricing in rate cuts and continuing rate cuts, and if that doesn't happen, if we see higher inflation, again, we'll touch on it more, but just straight up, yes, I think that would be a negative for the market if we did not see those rate cuts.
What markets benefit from that?
Oh gosh! So if we don't have lower rates, right now I would imagine anything that has to do. You're not going to see good things from small caps. You're not going to see good things from utility companies. A lot of these places that we've seen it lately. Probably the larger companies that don't have to worry too much about all the debt financing for growth, ones sitting on large, kind of the ones that have led, last year the most when we saw higher rates. We'd see a continuation of that. And we've kind of seen this rotation. It hasn't really gotten into small caps lately, but it's one of the things that, when I talk about things to watch for, there's some other areas that I think.
Tech companies, right?
So some tech, yeah.
Okay.
The funny thing is tech companies, these are a lot of the biggest companies in the world. They can do well with higher rates and they can do well with lower rates. So again, we'll kind of touch on some of this stuff, but there would definitely be, I think, more negatives than there would be positives. Okay. So inflation, we talked a little bit. It's still higher than our historical average, but it's on a downward trajectory, and everything that we're kind of seeing right now with positives in the market, positives in the economy are based, I think, on that assumption that inflation at least shouldn't be spiking back up. And so we'll talk about some of the challenges too. And that is one of the challenges. So borrowing costs are still relatively high, right? If we're looking at historical averages, small caps, every time I think, we talk about this one a lot, every time I think small caps are about to, be the next big thing and we can over allocate a little bit, they're just not quite ready yet, right? So, we need to see interest rates come down even further for that, I think, asset class to benefit more. The labor market, like I said, it's positive, but we've seen some signs of some slowing growth. You're seeing the number of people quitting their jobs is becoming less and less. So it's kind of like, well, there were all these jobs. I could easily leave my employer and go somewhere else. And now there's a little bit less of that, right? And the less new jobs come out, then the harder it is going to be for someone. And that's actually going to help with wage pressures too and inflation overall. So again, inflation, I think that's the one that we were concerned about for such a long time. Got to be a little bit more where the Fed was talking more about the job market and kind of concerns there and a little bit of cooling of the job market. But now you're starting to see a little bit of trickling in of, well, economic numbers are coming back great. Inflation occasionally gives us a higher number than we were anticipating. So there is a little bit of a fear of kind of a reignition of inflation. I kind of look at it like this. The trajectory on inflation is down. You're not going to have every reading come back down. I think you're going to occasionally see some spikes, but there's nothing really too over exuberant right now, I think, with the economy. It's good, it's steady, but there are good signs that tell us that the Fed and their path and what they're kind of broadcasting to us right now, I'm thinking that should come to play. But you got to have an open mind, like I always say.
I just read an article about deflation. And that is starting to pop up, and I can't imagine why that would pop up now. But the price of vehicles, for example, are down 1% and 5% off of all-time highs. So are we calling for deflation in the future or just a slower rate of inflation?
I think certain segments you could see some deflation. It happens from time to time. But overall, I'm thinking we're just talking about a lower pace of overall inflation.
Yeah.
And that's a big positive for the economy, obviously.
Yeah.
Some of the other challenges I see, we did a whole podcast on election uncertainty. I try not to read too much into, what the market is telling us right now. I think that's a lot of what I'm seeing is, what could this recent uptick in the market be telling us? Who's going to get elected based on these numbers? Certainly not, going to use that as my investment thesis at this point. A lot of what I try to do is kind of, okay, well, let's react to what actually happens instead of trying to predict. So I've been bullish going into this election just because of what I'm seeing, and I'll kind of talk about that with my scorecard. But, there's certainly some surprises that could happen. And like I said, you need to kind of go in these things with an open mind that maybe you're wrong on something and need to shift course.
Yeah.
Right. Then there's geopolitical risks. I kind of, you hear about this stuff a lot, but the wars in Ukraine and Middle East, commodity prices haven't really done a whole lot with that. Like oil prices are very subdued. There's a lot of production of energy right now, so that's probably helping. We don't have an economy where we're just, building things like crazy right now. So, I think I'm watching that, but I'm not like, oil prices, I expect those to go crazy, right? It's pretty subdued right now, but, that can change. So we get into the markets. What did the markets actually do? So first we talk about the economy, and then how did the markets actually react? So we talked a little bit in the last review, expected some volatility, and we actually got that. So about halfway into July, we saw pretty shaky markets. The NASDAQ was down from its peak to its bottom 18% at one point. S&P 500 was down 10% at one point. By the end of the quarter, though, for the actual quarter, the S&P 500 was up a little over 5%. NASDAQ, not as the comeback wasn't quite as strong, but it finished in the positive, almost call it 1.75%. So if you're the type of investor that looks at your account every day and you saw, oh man, my tech stocks or my overall stock index, S&P 500 index is down this much, maybe that caused you some concern, right? Yep. But if you are the type that just looks at a statement or doesn't look at your statement, then what you saw was a positive performance, likely if you're a stock investor for the quarter. And bonds were up as well. So it ended up being a very strong quarter. I talk about, a lot of the stuff I go over is kind of the seasonality and talking about the months and, historically, what have we seen? You can cherry pick anything you want to. So I try to stick to some recent data and not go all the way back to like 1929 when things were completely different. But if you look at most years, you're going to have some down periods of time in the market. Actually, it's only been 1 month so far this year. And we're obviously in a new month right now, but it's only been 1 month this year that we've been down. It's April. We were down a little over 4% in April. The rest of the months so far, in an election year, it's a very unusual thing that we've been positive every other month.
I don't even remember April being down.
Oh, gosh,
I remember August. I'm
sure I hear about it a lot more than you do. But August, we were actually coming back out of the hard stuff from July. You kind of hit the bottom in August. And then through the end of the month, and then into the end of the quarter, great results. And now we're starting to see kind of a continuation of that. And we're only a few weeks away from the election. So obviously anything can happen. But I usually look at this stuff as when you're seeing new highs get hit repeatedly, that to me is a bullish signal. So I'll talk about that when we get to the my cheat sheet. But bonds, that was one of the things I wanted to talk about in the second quarter, because our conservative investors, our moderate investors, we rely upon bonds for stability and income, right? And we were in what you could call a bear market for bonds for quite a while, with interest rates going higher. Now it seems to be, I would definitely call it stable. We're starting to maybe see a shift in the trend for bonds being up. And these things take time, but it was a tremendous positive to see bonds do what they did in the third quarter. Long-term treasuries were up almost 9% in the quarter. The aggregate bond index was up over 5%. So year to date now, we're actually seeing most of our bond funds being positive, which I can't tell you, that's been a blessing for me personally, for my clients and for what I deal with. Just a nice turnaround. And if interest rates are indeed kind of heading down further, if the Fed is right on that path, then we should see that trend continue.
So I have a random question that you are in no way prepared for. So tell me if you have to go back and look this up, or we can get rid of this. This happened yesterday. Well, it didn't happen yesterday. I met with a prospective client yesterday, and they are in a TIPS fund, which you can explain what that is. And they put a pretty significant amount of money into the TIPS fund in 2020, which you would think would be perfect timing, right? Based on what it is, and I'll let you explain that. But they put it in 2020. It's actually the only fund that they have that has lost a significant amount of money during a time in which it should have made a lot of money. So take that where you want to, and it just explain what the TIPS is, and then it just doesn't make sense to most people.
So TIPS is a Treasury inflation protected security. It's designed to try to help you endure these high bouts of inflation, investing in things that are a little bit more fluid. But that's the danger in those is sometimes it's one of those, I want to be a contrarian about certain things. For a certain period of time, those did great. And that was when the inflation was spiking. But since then, like if you go and look at an actual chart of inflation, you see how much it's come down. Those are not going to actually do well. And for a lot of the stuff I do is trend following. So, I'll say, you're going to see you're not going to get all those early results because I need to see the actual trend change before I get into something. But mostly you're just getting good performance out of those. It's more of like a hedge against your other things when inflation is spiking. But similar to like, let's say the VIX, right? The VIX can spike significantly. You can make a lot of money when the VIX spikes if you're in the VIX, but most of the time you're losing money in the VIX because it's just an insurance essentially on the stock market.
Yeah, it's just I was looking at it and I understand this, most of it, but it's the highest inflation rates in 40 years?
Oh, yeah.
They got in at the perfect time, and it is still down. So is that a case of unless you know exactly when to get out, you're going to lose money?
I think in those, like I said, it's more of I would just use them as hedges or insurance. It's not like I would never encourage someone to put that's where all my bonds are going into something like that, right? Because they're not going to be giving you the same coupons as a regular bond, and what we're looking for is income and stability, right? So these things do tend to be a little bit more volatile in other times.
Yeah, it's just interesting. So sorry. Anyway, I wanted to ask about the bond question.
So. All right, so back to bonds. Yeah, year to date now, S&P 500 and NASDAQ both up over 20%. You got the Russell 2000 that's up about 10%. The Dow was up over 12%. Emerging markets, this is somewhere we're starting to see some accommodative government liquidity in emerging markets. So those have been performing well. Those are up over 14% for the year. And developed markets are up over 10% for the year. So everything equity-wise, so this is the major categories I'm looking at every week. There's lots of different subcategories, but that's going to kind of give me my temperature gauge of what the markets are doing. And then again, I want most bond categories are up. The aggregate bond market is up over 2% for the year. One of the other things that we're seeing that's actually very encouraging, we kind of talked about it last time, market breadth. Right, so it's one of how are all the sectors of the market doing? Is it just a few that are carrying us? And for a while it was, right? It was your consumer, not consumer, it was communication services, technology. In the second quarter, those are the only sectors that were up a significant amount. They were up over 10% each. We're starting to see more sectors, and I talk sectors, and I know you always like me to clarify this, but sectors is just parts of the market, industries. You can subdivide the market into all these different categories, and which are the ones that weigh the most in an index. So only 4 of 11 S&P sectors were in the positive in the second quarter, and we had only 2 that were actually negative this last quarter. So we saw a more broad participation in the stock market, and that was definitely a good thing. We're seeing different leadership. Utilities were up 20%. Real estate up 17%. There were 4 other sectors that were up over 9.5%, most of them over 10. Industrials, materials, staples, financials. So with some of this change, I always am trying to look at how much of that is what do I think is that's a change in the leadership for a longer period of time, or is this a shorter period? Are we starting new trends? So that's some of the stuff I want to watch in this quarter is which of those are real and which of those are kind of just a little bit of a pop and drop, so to speak. But year to date, all of our S&P sectors are in the positive. All right, so I'm very ecstatic about that. Got technology, utilities, communication services, and financials leading, right? But we're starting again. We're seeing some new leadership in the recent months, the last 3 to 6 months. So, it's definitely an area I'm focusing on. And I want to know for the next year, right? As we start to get to the end of this year, where do I think my leadership's going to be? Because that's where I'm going to want to properly position for the start of the new year. So we'll talk more of that on the fourth quarter podcast. But I just want to give people a little heads up of where my head's at.
Yeah. So I want to go through your scorecard, but I think my makeup people, John, are asking me right now. So if I'm an investor and John knows this stuff, I'm never going to know this stuff, right? Like, this is why people hire folks to manage their assets. If I'm an aggressive investor, like based on the things you just said with the different markets, like how much am I in the S&P or in emerging markets or these other areas that you talked about? And by the way, also you said pop and drop. I think that was a rap song when you were in college.
Oh man, a lot of classics back then.
So pop and drop, and then give us the percentage of allocation that goes to these different. I'm just going to skip
over pop and drop, but yeah, I'd say most. If you're talking about the average person that's got money in a 401k, if they're in an allocation fund or if they are picking like most of the time they'll just be like large cap growth, large cap value,
yep.
Or S&P 500. I'd say the people I see and meet with that are coming from that, most people have money in their retirement accounts. Your makeup of, I'd say stocks are mostly in those categories, unless that person has saw, oh, wait, I see, small caps did great this last quarter. Maybe they're starting to allocate more to that. I'd say that's what most people are accustomed to doing, is looking at the previous results, yep. And kind of shifting those. That's why, how many times did you see, was it the mid-2000s, people in just a bunch of international?
Oh, everybody bought international.
Because international was outperforming
70%
S&P 500 United States companies. So, we like to preach, obviously, diversification and sticking to a strategy. Most of the strategies I would encourage people to have are going to have mostly United States large companies in them. So, even if you're in an S&P 500 mix, we talked a little bit about it in the last couple podcasts, but that mix is based off of the largest 500 companies in the United States and their market capitalization. So how much they're worth in the open market, the amount of shares they have times the stock price. So S&P 500 is weighted more towards the largest companies. So you're going to have Apple, NVIDIA, Google, all those giant, Microsoft, big companies are going to make up most of it. So if you went and looked, okay, I've got Vanguard S&P 500, fund, you can see the top 10 holdings and the percents that they are, right? So that's not going to change too much year over year. It's going to change when these companies get valued differently by stock prices going up or down, but it's not going to change drastically, right? So when I talk about that stuff, it's mostly to let people know if I see more categories going up, that's a good thing for your S&P 500 mix in general. I mean, it was also good when the biggest companies were doing the best, right?
Right.
But it's all, we want to try to get that rising tide to lift all the ships, and that's a healthier market, I would say. So yeah, let's get to the economic scorecard. So first thing I look at, again, GDP. I said it before. I say it's steady growth. I'd view it right now as a positive for the markets. The consumer, still viewing them as strong. There's the growth's slowing a little bit, but we're still in a good territory there. So that to me is positive. Industry. So we're a little mixed with our industry category. Say manufacturing still in contraction, but it's improving again, but that's a smaller portion of the U.S. economy. AI, tech infrastructure, you could only describe that as being almost exponential growth right now. Productivity in the United States, growing, right? So our companies are being profitable, but they're also the employees are more productive right now. So it's a pretty good mix. I would give this as a positive. Jobs market, say it's strong still, but it's cooling. So there was a point where it was probably too strong, and now it's more balanced. So I'd still say it's positive. Housing, I'd call this subdued, right? You've got kind of two different areas of housing market. So prices are stable. That's good. Existing home sales declining right now. So we're seeing mortgage rates coming down, but they're not coming down fast enough to prompt a lot more people. So we need to see that if the Fed kind of continues on the path that they're saying is likely, then we should see over the next year mortgage rates decline more. We should see more supply come on the market. So I'd basically say I'm pretty neutral on that. So new home construction, like the new home builders, again, doing well. Those stocks are doing well. We're seeing at least housing starts are coming down, the number of those, but they're still very profitable, right? Inflation, it's elevated, it's moderating. We're seeing the more stickier areas are in our services because I think people are still doing a lot of stuff, right? Anecdotally, yep. I have friends, family, traveling, hotels, all that industry is still pretty perked up. Housing prices stable, but rent still pretty sticky. So these are big chunks of someone's budget. It's still, I wouldn't call it negative, but I would definitely be on the more neutral with that. So that's all the areas of the economy. Overall, I've got nothing that I'm looking at as negative. So then the market scorecard, what are we looking at with the market? Stocks, my first thing, are we in a bull market? That's the very first thing I want to know before I'm looking at any other type of investing. Are we in a bull market for stocks? We absolutely are in a bull market for stocks still. I said it last time, setting new highs, not every day, but almost. So that to me, that's a positive. Market internals. So what are the some of the stuff going on inside the market? Touched on this last time. So the amount of stocks that are advancing minus the amount of stocks that are declining. We had overall, it's been great this year. You've seen that advanced decline going up when the stock market is going up. There was a brief period of time toward the end of the quarter where that started to actually inch down while the market was going a little bit sideways and started going up. Kind of a sneak peek for fourth quarter, that's actually reversed. So I'm still viewing that as very positive right now. The market breadth is good. New highs to new lows, lots more companies setting new highs than are setting new lows. That's a bullish signal. Good shape there. Percent of companies over their moving averages. So that's just a way, that's a technical term that tells me, are we in an uptrend or are we in no trend or are we in a downtrend? So when you're seeing this amount of companies, over and above their 50 and 200-day moving averages, that tells me we're in uptrends. And I don't, those to me, I don't change my thesis until that trend changes, right? So right now, uptrend, I'm very positive on market internals. Next thing, volatility. It's elevated. It's slightly elevated. It's not a concern to me, but it's something I'm watching pretty closely. I happen to believe, and I try not to let that filter in, but if I had to guess, volatility changes after the election, either up or down, right? So either this elevation turns into some massive spike for some reason at this point. I don't know what the market's going to do. I just need to know how to react to it, right? My probably base case would be that volatility declines after the election, but we'll see. So right now I'm pretty neutral on that. I do think it's elevated. I do think it's worth watching, but it's not, it's not actually flashing me a signal of. At the same time, markets are setting new highs, so it's like that's kind of my more, the thing I'm paying attention to more. But I always talk growth versus value, right? Yep. So what do I want to be leaning into? Growth had pulled back pretty significantly with, it was the beginning of that third quarter. We had the volatility. We had kind of jobs looking like they were starting to go south, right? Unemployment was ticking up. So growth pulled back, but it did stabilize, and now it's starting to look like it could turn back around. So I'd say I'm pretty neutral right now if it comes to portfolio weighting between growth and value. But I think that will probably change soon too. Treasury yields. So, we peaked in October of 2023 with a 5% 10-year Treasury rate. It came down to about 3.8 at the end of the quarter. Since then, kind of again, sneak peek into the fourth quarter, we're up a little bit over 4% on the 10-year Treasury. I still view that as kind of, it spiked again on some positive economic news. I think, again, the markets maybe got a little bit ahead of, what interest rates were going to do and how fast. I think interest rates, if you had to, make me make a call on it, I still think that they're going to be lower by this time next year. I think the Fed has been, broadcasting that, and short of this major economic boom and spike in inflation, then that's what I would think would play out. But I'd say overall, I'm slightly positive when it comes to the thought of lower interest rates in the next year, right? So that's kind of where I sit on that. Bonds, I would just call them improving. Like they're not the place yet to go gung ho, pedal to the metal. Like let's pour a bunch of money in bonds, but it's certainly a much different situation sitting here today than it was last year, right, in bonds. So we do have some tailwinds when it comes to interest rates that should help bonds. So I'm pretty neutral right now, but definitely looking at that one a little bit closer, that the trend could be changing to upward for bonds.
John, the next time you get home and your wife says, "How was work today?" I want you to give her your economic scorecard. She will never ask again, and it's going to be a beautiful thing.
I could keep it short.
I'm not saying it was too long for us. I'm just saying.
This podcast has to have some info. If I just sat at the beginning and be like, all right, everything's good. So, keep doing what you're doing.
So I have two real questions, then we'll wrap it up. These setting new highs as a bullish trend, right? So you keep saying like that's a good thing. A lot of people would say, well, that means at some point it's going to come back down. It can't just keep setting record highs all the time. Why is that a bullish trend? Obviously, besides the fact that it keeps going up and breaking records.
All right. So I've talked about this before many times too. It's not worth your time, and it's definitely going to cost you money by trying to call a market top. All right. So think about it, I guess, in terms of I've got, it's a supply and demand thing, right? So if I've got a certain amount of companies that I'm selling and they're valued at a certain price, if there are more people buying those companies because they think they're going to go up, then that raises the price, right? So right now we're in a situation where the market is telling me people are willing to pay higher prices because they keep paying higher prices, right?
Yep.
Sure, that will change at some point, right? But neither you, me, anybody else on the street can tell me when that's going to be, right? So I ride the wave until it's over, and I can, do well performance-wise while that wave is happening, right?
Yep.
And that's how I look at the overall market and all the subcategories that we try to, make a little bit more returns on, right? So if I'm over allocating to one place or another, it's because that's a bullish category. Kind of to your point, I have what I call worried client number one. And every time worried client number one tells me, is this the time, it's doing great. Should we just get out? That I don't keep the actual statistics. I tell myself all the time I should. But, I can pretty much star on a stock chart on the S&P 500 over the last 10 years every time I've gotten that message from that client. And it's 100% of the time it's up.
Well, it has to be. We're at an all-time high.
We're at all-time
So they've been
high.
wrong the whole time.
Right. So I'm just saying that most people, like, if I were a stock market bear, right, there's a lot more money in being someone that's outspoken about being a stock market bear, because everybody wants to be right on that, right? All my clients think that it's time to get out, right? Unless, I've done a good job coaching them.
What's the saying about calling the market downturn properly? Like, I've called it 100 times.
Oh, yeah.
What is that saying?
I don't know exactly what. Basically, it's you can keep calling the time that you're right. You're the most vocal about it. Obviously,
Right.
like, oh, listen, I was right. But that person is typically calling it every step of the way. So they've been wrong for 3 years, and then when it finally goes down, they're right.
Yeah. You've been. I was right 100 times about the last one downturn or
Right.
something.
No, I mean, I see plenty of these people in social media and on the financial news and all that. So. I'm just telling you, when markets are setting new highs, that's a bullish statistic, bullish category. Eventually, yes, of course, that's going to come to an end. But again, there's no way to really predict that.
Yep.
But typically what's happening is once you're kind of breaching these new levels, and I'll put it to you another way. We talked about the amount of money that's in money markets, safe categories, right, that have been earning high rates of return. As interest rates come down, those rates are going to go down and down. They might not, immediately plow into equities, but we did see some of those statistics and numbers when we did the election podcast, right? And then in the first year of a presidential term, the first new year, so January 1st after the inauguration, you typically see more money flow out of the money markets and into stocks, right?
Yep.
So again, you can't always just gauge what history is going to do, but if I'm thinking about it, the stock market, whether you want to believe it or not, it's a psychological thing, right? Most people aren't good about separating their emotions from their investments, right? So it is we're setting new highs, we're at elections coming up, like maybe this is just the time to sit on the sidelines. Well, it's happening. I'll tell you, 1,000% people are doing it right now. No doubt about it.
Yep.
I think our job as advisors and counselors is to prevent people. You've always seen that timing the market is better than timing the market, right? Like timing the market is next to impossible for most people, right?
Yeah.
I know it can be done. I've seen it done, but I'm just saying most people can't do it. So the idea for most investors is to just stay put.
Yep.
I've presented plenty of evidence on that over the last few podcasts. But they're going to provide that fuel for the market to keep going because they sit out and the market goes up another 10%. Now they're getting back in, right? So the market does need that fuel. Unfortunately, like I don't want my clients to be that fuel. I know you don't want your clients to be that fuel. So, the whole point is to try not to time that, right?
Yeah.
I think you can find on any given week a reason to say, why I need to, sit out.
100%. I mean, the scary tactics sell. If you say the
100%.
market's crashing on TV, it's way better than it going up 1%.
I can go on TV every day and do that, and people will gravitate toward me. They will absolutely love
They do
that.
anyway, John.
Oh, the ones, how many times you get that commercial? Oh, he's accurately predicted the stock market decline. And how many people are going out there and calling that? I bet you so many are.
Yeah.
So, no, I mean, let's do what we think is right.
So, John, I have one question before they kick us out of here. we're going to get kicked out of the studio, guys. In under 1 minute, because you mentioned AI as a sector, as a human being, John Harms as a person.
Are you sure about that?
Yeah.
It could be a robot.
Nice. Are you worried about AI?
No.
In general?
Not yet. No, absolutely not. Especially when it comes to how we invest our money and what you're starting to see that productivity go up. I know there's a bunch of that you can attribute to AI. Companies believe that right now. The biggest companies in the world are spending tons of money on it right now because they believe that.
Yep.
I don't think jobs are going away. There's lots of ways to help facilitate and to supplement that industry. But no, it's not something I'm really worried about yet, especially when you do. I don't know. I tried asking my car for, send me directions here. They can't understand me. So, until it's all like said and done and they're perfected, then maybe I worry that.
I'm not worried about it. It's for us, some like use cases. I took a picture of my chainsaw over the weekend. You go to Home Depot and the chainsaw wall is like 7,000 different parts. And you can put it into ChatGPT and say, find me the part I need for my chainsaw. It told me right where it was on the Home Depot wall. That's crazy. It saved me a bunch of time.
They're a lot of time savers. Yeah. And I know you're using them. So
I still run into people that don't know what's ChatGPT. I've never heard. That is amazing to me. Like, I am definitely the person that maybe a year ago when people said, hey, I don't go on Google anymore. I just go right to ChatGPT. And ChatGPT is one of many options now, but now I'm that person. Like, I go right to ChatGPT. I've designed our landscaping from it, obviously with the approval of my significant other. And but it's funny how people that now get it are using it for being more productive. So I think it will drive things forward. I'm not scared of it at all.
I'd say, great. At this point, I'm not scared. I think it's actually exciting to see what some of the companies are doing with it, and how that, I think, if you go into even healthcare, that's where I think a lot of the companies that are going to use this stuff I have a feeling there's going to be some really groundbreaking work in the healthcare and medical fields when it comes to disease prevention, treatment, all that. So,
interesting. All right, John, they are kicking us out of the studio. Appreciate the time again, man. We'll see you next quarter. Folks, make it a great day.
Intent here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. All investing involves risk, including loss of principal. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. Information here is provided, in part, by third-party sources. These sources are generally deemed to be reliable. However, neither 6 Point Financial Partners, Private Client Services, nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of 6 Point Financial Partners. They do not necessarily represent those of Private Client Services, RFG Advisory, their employees, or their clients. This commentary should not be regarded as a description of advisory services provided by 6 Point Financial Partners or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives through Private Client Services, member VINRA, SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, LLC, RFG Advisory, or RFG. A registered investment advisor. Private Client Services, 6 Point Financial Partners, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.